Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on the CBN's Monetary Policy Committee meeting, how it affects you, and our expectations. In view of the CBN's Monetary Policy Committee MPC meeting today and tomorrow, we thought to shed a light on the role of the committee and how their decisions affect you as well as our expectations. The MPC is the highest policy-making committee of the CBN, set up to facilitate the objectives of the bank, including price stability, which includes interest rates, inflation and exchange rates, and providing support for the federal government's economic policy. The committee reviews the developments in the global and domestic economy and financial markets before arriving at its decision during each meeting. The committee is composed of 12 members and is chaired by the governor of the CBN. The MPC meets 4 times a year to formulate monetary and credit policy. The communique of the meeting is always published on the CBN's website at the end of the meeting. The decisions of the MPC reflects the direction in which the CBN wants to nudge the economy. Usually, this could be to expand economic activities or to slow the pace of economic activities so as to reduce inflation. We discussed in details the key decisions made at each MPC meeting and how it affects you. 1. Monetary policy rate (MPR). The MPR is the reference interest rate against which other lending rates in the economy are pegged and is commonly used as an instrument to control inflation in the economy. If the CBN wants to discourage you from borrowing, it will increase the MPR, leading to an increase in lending rates, both new and existing loans, that is, increase in the borrowing cost. For instance, the MPR is currently 11.5% and prime lending rates, which is the rate charged by banks to some of its top and credit-worthy customers, at 11.6% as at June 2021. If the MPR is increased by 2%, the borrowing cost will most likely increase by almost the same rate and vice versa. Most customers access loans at the maximum lending rate, average highest lending rate, which is currently at 29% as of June 2021. This is less responsive to changes in the MPR. The CBN tries to maintain a balance between keeping inflation at a controllable level and supporting growth. To support growth, the MPC reduces the MPR to lower borrowing costs and increase access to loans. The opposite is done to control inflation. 2. Cash reserve ratios (CRR). This is the proportion of customers' deposit the bank keeps with the CBN. The portion deposited with the CBN is to prevent the shortage of cash when you make a request for your money with the bank. Currently, the CRR is 27.5%. which implies that if you deposit 1,000 naira with the bank, 275 naira out of this is kept with the CBN. This means that only 725 naira is available to the bank to invest or give out as loans. If the CBN wants to reduce the amount of funds available for loans, the CBN will raise the CRR. This makes it difficult for you to access loans in the bank. On the other hand, a reduction in CRR means banks have more money to invest or lend, which is released into the economy and leads to economic growth if properly used. 3. Liquidity ratio. This refers to the amount of liquid assets, cash, treasury bills and near cash assets that banks should hold to meet their financial obligations to you as their customer. This helps the bank to give you your money anytime you request for it or make a transfer. If the CBN raises the LR, more funds will be kept near cash to meet customer demand. Based on these explanations, you can understand the implications when the CBN makes any adjustment at its MPC meeting. At this quarter's meeting, which ends tomorrow, our expectation is that the CBN's MPC will keep the MPR, CRR and LR unchanged. Our view is based on the reduction in the inflation rates in the last 3 months, though the decrease is merely statistical due to strong price increases in the prior year rather than deliberate actions to slow the pace of price increases. The MPC may be hesitant to raise the MPR so as not to halt economic activity, which is still recovering. Keeping the MPR at current levels will mean that borrowing costs will not increase, which will be positive for growth. As a result, fixed income rates will remain subdued, which may spur more companies to raise short-term funds in the form of commercial papers. Thank you for listening. Please join us same time next week for another exciting and interesting session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 070-8246-3747. Stay blessed.